All right, let's get right into it. Today, we are talking about a seriously powerful tool that honestly, every business needs to get a handle on: marginal analysis. We're going to see how looking at your numbers in a very specific way can be the absolute key to making smarter and way more profitable decisions.
So here's where we're headed. We'll kick things off with a fundamental business puzzle. Then we'll pick the right tool for the job, and that's all about contribution margin. After that, we'll figure out how to find your break-even point. First for just one product, and then for a whole portfolio. And finally, we'll get into the crucial difference between just surviving in the short term and being stable for the long haul.
You know, this is the question that keeps business leaders up at night. When you decide to, say, launch a new product or maybe just push to sell more of an existing one, how can you be absolutely sure that it's actually helping your bottom line? Let's figure out how to measure that impact and measure it accurately.
So many of the big decisions really come down to your products. Should we hike the price? Should we cut a product line that seems like it's underperforming? Or maybe launch something totally new? To answer any of these, you've got to have a reliable way to zoom in and see the profitability of each individual product, to see what value it's really adding to the whole company.
And that brings us to a really critical choice. If you want to measure profitability the right way, you need the right yardstick. The two most common ones you'll hear about are gross margin and contribution margin. Now, they sound pretty similar, but trust me, they tell two very, very different stories about your business.
So first up is the classic, gross margin. This is the traditional way of doing things, the one you'll see in pretty much any standard financial accounting statement. You just take your sales and subtract the cost of goods sold. Sounds simple, right? Well, the trick is what's hiding inside that cost of goods sold. And then we have our alternative, contribution margin. This one is way more direct when you're trying to make a decision. It's just your sales minus your variable costs. That's it. It only looks at the costs that go up when you produce one more item. And what that does is it perfectly isolates the true contribution each sale makes towards covering all your fixed costs and, hopefully, generating a profit.
Okay, so here's the absolute key difference. It's all about how they treat fixed costs. Gross margin, using a method called absorption costing, actually mixes in some of your fixed production costs, like factory rent, into the cost of each unit. Contribution margin, on the other hand, keeps fixed and variable costs totally separate. Now, this might seem like a tiny accounting detail, but believe me, its impact is massive. Let's see exactly why.
Okay, check this out. On the left, we've got a company that sells 10,000 units. If you look closely, whether you use the gross margin method or the contribution margin method, the final profit is exactly the same, $48,500. So far, so good. But now look at what happens on the right. The company makes and sells 2,000 more units. All of a sudden, the profit figures don't match up anymore. Gross margin says the profit is $58,500, but contribution margin says it's $62,500. So what in the world is going on here?
This right here is the heart of the whole problem. When the gross margin method figured out its cost per unit, it took a fixed cost, like the factory rent, and it spread it across the original 10,000 units. But when production went up to 12,000 units, that same fixed cost got spread across more units, which made the cost per unit look artificially lower. It basically treated a fixed cost as if it were variable, and that completely distorted the final profit calculation. And now, here is the proof. Just look at how the contribution margin method nails it. The total contribution margin went up by exactly $14,000. And the change in the final profit? You guessed it, also exactly $14,000. It perfectly predicted the impact of selling more units because it correctly kept fixed costs fixed. When it comes to making decisions, this makes contribution margin the clear winner. No contest.
So, now that we have our best tool, the contribution margin, let's put it to work to answer another super important question. What is the absolute bare minimum you need to sell just to cover your costs? This, my friends, is the break-even point.
The economic break-even point is that magic number where you're not making money, but you're not losing money either. Your total sales dollars are just enough to pay for all your variable costs and all your fixed costs. Think of it as the starting line for profitability.
And the formula to find it is actually not that complicated at all. It all starts with this simple idea that at break-even, your profit is zero. So sales minus variable costs minus fixed costs equals zero. If you just move things around a bit, you see that at the break-even point, your total contribution margin has to be exactly equal to your fixed costs. From there, it's a simple last step. To find the number of units you need to sell, just divide your total fixed cost by the contribution margin you get from each individual unit. Easy. And this visual just illustrates the whole idea perfectly. That rising line, that's your total sales revenue. The other line that starts higher up, that's your total costs. It starts higher because of your fixed costs. Right where they cross, that's your break-even point. If you sell any less than that, you're in the red, in the loss zone. But sell just one more unit, and every single sale after that is pure profit.
Okay, looking at a single product company is great for learning, but let's be real. Most businesses are way more complex than that. They sell a whole portfolio of different products, and each one has its own price, its own costs. So how in the world do you find the break-even point then?
Yeah, this is the big challenge, right? We can't just pick one product's contribution margin and call it a day. We need some way to blend them all together to get a single, meaningful number that represents the entire company.
So let's take a look at this sample company. It sells 3 products. And as you can see, their contribution margins as a percentage are all over the map, 40%, 50%, and 60%. But based on their sales mix, how much of each they sell, we can actually calculate a single weighted average for the whole business.
And for this company, that magic number is 53%. What this actually means is that on average, for every single dollar of sales this company makes across its entire portfolio, 53 cents is left over as contribution margin. That's the money that's available to cover fixed costs and then finally generate profit. This is our new key metric.
And with that number in hand, our formula just needs a slight tweak. Instead of dividing by the margin per unit, we divide our total fixed costs by that weighted average contribution margin percentage. But notice the key difference here. Because we're using a percentage, our answer isn't going to be in units anymore. It's going to be a break-even point in total sales dollars. And naturally, the graph changes a little bit too. Take a look at the x-axis. It's no longer units sold, it's sales in dollars. The core logic is exactly the same, but the measurement is just adapted for the complexity of a real-world product mix.
Okay, for our last concept, let's add one more layer of nuance. See, not all costs are created equal. Some of them require you to write a check right now, and some don't. And this leads us to 2 different kinds of break-even points that are both really important to understand.
The economic break-even, which is what we've been talking about, is all about long-term stability. It makes sure you cover all your costs, including non-cash expenses like depreciation on your equipment. The financial break-even, on the other hand, is all about short-term survival. It only worries about the costs you have to pay in cash right now. Its goal isn't to get to zero profit, it's to get to a point where you have zero negative cash flow coming from your operations. This graph shows it all perfectly. The financial break-even point is always going to be lower because you just need fewer sales to cover only your cash costs. But the really critical area to understand is that zone in between the 2 points. If you're operating there, your business is generating positive cash flow, which feels great. The bills are getting paid. But you're still taking an economic loss because you aren't covering the cost of replacing your assets over time. It's the classic state of surviving but not thriving. So, look, knowing these numbers is just step 1. This analysis gives you your baseline, but understanding whether your business is just getting by on cash flow or if it's truly stable for the long haul, that's what gives you the power to make real strategic decisions. So the real question is, now that you know how to find your baseline, what are you going to build from